Now we are going to talk about another concept which is called group share based payment, and I try to explain this to you very briefly, which is to say that if I have a holding company, right, and I have a subsidiary company, right, and if I give the stock options, the holding company gives stock options to the employees of the subsidiary, right, that's a group share based payment arrangement, or you may get it from your shareholder, right. That's the another possibility, and so when basically, and we see this in a lot of this in the context, a lot of multinational companies in India, right, which are, let's say there's a company subsidiary in India, the parent is in US, and they give their stock options to the employees in India. All kinds of arrangement is what we see. So we will try and understand this with some of these scenarios. So there is a subsidiary which is receiving the goods or service based on share price of parent or based on share price of the subsidiary itself. It is settled in shares or it is settled in cash. It could be cash settled, could be equity settled, or it could be settled in stock. All of that settlement is done by the parent, or it is done by the subsidiary, or the settlement is done by the shareholder. All possibilities in a way exist in relation to the group share based payment arrangements. So I think let me help you understand. It's a slightly busy in a way a slide. So I think when you look at it this, right, the a compensation cost, the expense is required to be recorded in the books of the entity which is receiving the benefit of the employee which is providing the services, right? So if the subsidiary employees are getting benefited, then the compensation cost is to be recorded in the books of the subsidiary. Okay. The holding company is not receiving the services. The holding company in a way is giving a grant to the subsidiary. In a way, they will record this as an investment in subsidiary. Okay. In the consolidated financial statement, anyway, all of this is eliminated. Doesn't matter. The expense will come in. The investments and capital in a way will get knocked out. So that's how, and whether it's equity settled or cash settled, and whether it's settled by the subsidiary or the parent, all of that in a way will impact the accounting, the recognition in whose books I need to record. All of that is what you need to be careful about, right? So that is what this slide is trying to explain to you. If it is a subsidiary receiving goods or services based on share price of parent or on share price of subsidiary, settled in stock or settled in cash, settled in or stock, settlement done by the parent, then equity settled, books of the parent, or it's a group settled. So whether it's a cash settled or equity settled is what you need to determine, and that will help you determine the accounting, right? Let's try and take an example on this. ABC company is the parent of XYZ Limited. Okay. Now, ABC grants 200 share options to each of 100 employees of its subsidiary XYZ. 100 employees of subsidiary XYZ. How many options are granted? 200. Based on the 2-year services with the subsidiary, the fair value of the option on the date of grant is 30 rupees. How have you determined the fair value of the option? Using the option pricing model, right? Which is what I just explained to you, right? The option pricing model, which has number of inputs, which goes into, which is exercise price, market price, interest rate, dividend yield, and then volatility. All of these are your inputs to the option pricing model. So at the grant date, the subsidiary estimate that 80% of the employee will complete the 2-year service period, right? The estimate does not change during the vesting period. Now, at the end of the vesting period, 81 employees complete the required 2-year of service. Okay, 81 employees complete the required 2-year of service. The parent does not require the subsidiary to pay for the shares needed to settle the grant of share options. Okay, the parent does not require the subsidiary to pay for the shares needed to settle the grant of the share options. Now we need to pass the necessary journal entry for the arrangement mentioned above. Okay, awesome. So essentially, so what is happening 2-year, right? And I estimated that 80% of the employees, so out of 100, 80 will vest. Eventually 81 it vested. Parent does not require the subsidiary to pay, right? So it's the share settled payment arrangement. Okay, the fair value was 30. So how much is my total compensation cost? And then how much I need to record in year one, how much I need to record in year two, and then, what are the journal entries? Awesome. So accounting entries in the books of the subsidiary, right? Year one, employee expense debit 2,40,000, which is 200 into 100 employees into 80% into 30 divided by 2, because they're 2 year, right? To equity 2,40,000. Contribution from the parent. Year two, right? Employee expense debit, right? 2,46,000, because essentially we've got actually 81 instead of 80. That's why this number has changed. Okay. And I had already recorded 240. So the balance gets recorded. Okay. Credit to equity, right? Contribution from the parent. That's how you will do the accounting in the books of the subsidiary. Okay. In the books of the subsidiary. The parent, if they were to record, they will record entry investment in subsidiary in their standalone financial, and that's debit and credit equity, because they have issued stock, right? Credit equity, debit investment. They will not record expense in their standalone books. When they will consolidate, right, this investment and equity in a way will get knocked off, and then they will be left with their own equity, which is what they have issued, and the expense, which is going to get recorded in the consolidated financial statement. So we'll quickly revisit what we have talked about. Does counterparty get my equity instrument? Yes. Equity settle? No. It's again another part in the same group. Do I have to provide those instrument? Again, yes. Cash settled? No. Equity settled? Again. So lots of optionalities is what all of that is what we need to be careful about in terms of assessing whether it's an equity settled or a cash settled. So equity settled, generally if the arrangement is going to get settled by issuance of shares. A cash settled, if I can't settle in stock, then I have to pay cash with reference to share price, then it's a cash settled, right? And then the accounting for equity settled known at the date of the grant. For cash settled, it keeps on moving and to be only known on the date of the settlement, so to say, when the liability is set. Now comes the disclosures, okay? And disclosures means disclose, and disclose, right? And there are a whole host of other complications. See, stock options is a complicated topic. We've not tried to cover every element, every complication, right? Because I know I personally don't believe that that is relevant for the purpose of examinations or for the purpose of, the CA final curriculum. So I think the key for you is to understand that that these are your stock options arrangement, these are cash settled or equity settled, and then how you determine the total compensation cost. You factor in the forfeiture, what is a market condition, the performance condition is a market condition and a non-market condition. And a market condition, once even if it's not met but the service condition is met, then the cost is not allowed to be reversed. In a non-market condition, if the service condition is met but the non-market condition is not met, then you are allowed or required to reverse the cost. All of this is what you need to fully understand, appreciate. Equity settled is cost to be determined on the grant date, whereas like cash settled, cost is continuously trued up till the time the liability in a way settled. We talked about several other things, the grant date, the vesting period, the vesting date, the vesting conditions, the exercise date, or the total contractual life of the options. Number of things is what we talked about, and is what I would again encourage each one of you is to look at this and get your principles cleared and do a lot of practice of the type of questions which are coming. Couple of that, lots of that actually we've covered here, but you also try to do more and more practice. The more practice you will do, I think the clearer is going to be your concept. We of course also talked about the modification, the cancellation, the settlement. All of that is what we talked about. How do you account for the modification? So we got to be again acquire the full understanding of how the accounting for stock option arrangements do work, the type and scope of the arrangement, the description of the agreements, the number and weighted average exercise price of share options, the average price of the exercised option. Again, this is a disclosure which takes a lot of space in the financial statement of any company. So again, I would encourage you to look at listed companies, the financial statements, and look at the stock options related disclosures. You will see number of tables which are out there, right? Which gives you a whole summary of what's the stock option plan, how many granted, how many vested, how many unvested, how many outstanding, how many got exercised, how many got forfeited, how much was the compensation cost, how have they determined the compensation cost, what are the assumptions which goes into the option pricing model, because this is also a matter of accounting estimate. These assumptions can change your accounting estimate significantly. So the valuation method, the impact on the income statement, all of that is what you need to look at carefully. Now, quickly to help you understand the difference between the Ind AS and the Indian GAAP, whole host of differences, okay? First difference is that Indian GAAP allowed you to use the intrinsic value. What does that mean? If the market price of the stock and the exercise price of the stock on the date of grant is same, okay? Say 25 rupees is the market price of the share on the date of grant, and exercise price is also 25 rupees. Indian GAAP said it's a zero compensation. You're not giving any benefit to the employee, and hence no compensation cost to be recorded, okay? So it's an accounting policy choice. You can do intrinsic value or you can do a fair value. Whereas Ind AS says that since you are giving an option to the employee, it's a right available to the employee that they can exercise this after the vesting conditions are fulfilled, which is a long in duration, 3 year, 4 year, 5 year, and you go and buy options of Nifty options or any stock options which are listed, right? They are valued, right? You have to pay a premium to buy those. So essentially the option pricing model is also try to determine the amount of premium, right? Or the fair value, which I as an employee is willing to pay, which is by paying how? By providing my services. So that's what, the Ind AS makes it mandatory to use the fair value as a measurement technique, valuation technique to determine the value of the option. Whereas, in Indian GAAP allowed you to use the intrinsic value. Okay. Now, transaction with non-employees, there is no guidance under Indian GAAP on this. Again, there's a specific guidance under Ind AS. It covers how do you measure them, how do you account for them. All of that is explicitly covered. If there are graded vesting, okay, we've not talked about in detail, but I'll just explain to you. So let's say, there are 500 options granted to an employee A, okay, and said this will be vest over a 5 year, and then there are, say, 5 year, then there are 5 year 1, 2, 3, 4, 5, okay. What the arrangement says here, 100 will vest every year. This is called graded vesting or staggered vesting, which is what I tried to cover, right? 100 will, so there are two ways it can vest. Either say 100 will vest every year, or you say 500 will vest at the end of 5 years. These are two types of arrangement, right? A graded vesting or a bullet vesting, okay? So let's say in a graded vesting, okay, Indian GAAP, so now your total cost, let's say the cost per option is 100, okay? That means the total cost here we are talking out is 50,000. Okay, the cost per option is 100. Okay, cost per option is how much? 100. How many options I have given? 500 to A, to Mr. A. Okay, to Mr. A. Okay, these are the number of options, and the cost per option is 100. So total cost is 50,000. Okay, now we are saying they're going to vest over every year over a 5-year period, or we say vest, at the end of the 5-year period. So what essentially the accounting is saying, if you were to vest at the end of 5 year, assuming this guy completes 5 year, so every year you need to record a compensation cost of 10,000, 10,000, sorry, 10,000, 10,000, and 10,000. Okay, that's one simple accounting if it is a bullet vesting. Okay, now that is what is permitted under Indian GAAP. Whether it's a bullet vesting or whether it's a graded vesting, you can do this. However, Ind AS suggests that graded vesting is made as in substance there are multiple awards. What does that mean? Every year is treated as an independent year. So in year 1 you will record 10,000. And then for year 2, you will record 5,000 and 5,000. For year 3, you will record 3,333, 3,333, 3,333. For year 4 cost, you will record 2,500, 2,500, 2,500, 2,500. And for year 5, you will record 2,000, 2,000, 2,000, 2,000, 2,000. Means every vesting is treated as an independent award. Okay, that means in year one your total compensation cost is very significant, and you keep going down, the compensation cost keeps coming down, because every year is treated as a separate grant. There are 5 grants in a way. Okay, 5 grants of 100 shares each made to this employee. Now, if that been the case, that is how you determine. So in year 1, your total cost is this, in year 2 this, year 3 this, year 4 this, year 5 is this. That is called accelerated attribution method. This is called accelerated attribution method. Okay, that is what is required in the case of a graded vesting. Now, Indian GAAP gives you a policy choice. Okay, Indian GAAP gives you a policy choice, to straight line basis as a single award, or an accelerated basis. You can do 10,000, 10,000, 10,000, or here you don't have a choice. Under Ind AS, you don't have a choice. Here you have to do every vesting as a separate grant, right, and record the cost accordingly. That's the difference between Indian GAAP and Ind AS. Awesome. Thank you very much. Thank you very much. I hope this is useful to you, and do reach out if you need any more help on this. We have a bunch of questions again, which I'm going to request my colleague to take you through. Thank you.